We've got Arnab Banerjee, who's the Managing Director and CEO, now joining in. Thank you for taking time out. And I wanted to get in an overall view, given that the automotive industry is facing inventory issues, be it PVs or two-wheelers. There is a lackluster festive sale, it seems. So how are you seeing demand evolving, and are you feeling the pressure?
Yes, I think you're talking about the OEM segment when you're talking of automotive. There is inventory buildup there. We have three business units: aftermarket, OEM, and international business. Our aftermarket business is growing very well in double digits value-wise. Our international business is growing very well in significant double digits. OEM is subdued. A, because the demand is low, and B, because we are doing a refresh of the vehicles in which we would be approved and be present. So the exits have happened, the entries are happening. And in half two, OEM also will come back strongly for us because the entries would happen mostly in half two. So we are looking at a very positive volume growth for CEAT in half two. And quarter two was also pretty okay at 8.5% value growth.
Sure. You know what I want to talk about right now is how your quarter went by was, Arnab, because one is seeing that there has been pressure on margins, profitability as well. What I want to understand is whether this was a one-off, especially the margin hit, because of the increase in raw material costs, the employee costs as well, seeing an uptick, or do you think that this is a bit of a trajectory change now?
No, we never predicted or anticipated that raw materials, especially natural rubber in India, would go up so much so soon. So quarter one over quarter four was a growth of overall raw material basket grew by 4-5%. Quarter two over quarter one, Q on Q growth has been 6%. This is very, very steep growth in a very short period of time. Natural rubber prices in India saw a 15-year high. Not anticipated, not projected, unlikely to happen again and again. So the transmission of rates through finished goods to the market has been inadequate in quarter one and quarter two, though we took very strong increases in quarter two, especially towards the end, which will come in handy in quarter three. Quarter three raw material outlook is much more sober. The growth rate we expect will taper down to about 1.5-2% Q on Q. And as we enter the tapping season of rubber, we should be seeing a flat or marginally declining prices in quarter four. So I would say that the raw material growth spike in quantum and speed has happened at its maximum in quarter two.
Sure. But since you're saying that you do not take adequate price hike, suffice to say that there would be some more perhaps in the coming quarter?
Yes, we took a very steep price hike right at the beginning of quarter one, and in fact on the 1st of October in passenger car segment as well as on the truck bus radial segment. And more hikes are planned in October itself, and we will look at the situation in November and December to cover the deficit.
Okay, fair enough. Let's move right on then and also talk about the decline in raw material prices, because we've seen that from Q3. How much of a boost do you anticipate that having on your overall margins, and what is your strategy to leverage the situation?
Raw material prices won't decline in Q3 vis-a-vis Q2. The growth rate will taper down, and we still expect an inflation of 1.5-2% Q3 on Q2. So we have to cover the deficit, which is already there, plus the additional inflation of Q3 has to be covered by further price hikes. So in Q4, it will be flat or maybe marginally declining. We think so. So there will be a progressive improvement of margin, mostly in Q4, and Q3 also we have to cover up the deficit.
Your aim for a double-digit volume growth for the full year FY25, are you still standing by that target given the current market conditions, or will that be revised?
Yes, so I explained how the different business units are working. We are having strong double-digit volume growth in international business, which is margin accretive. We are having double-digit growth in replacement aftermarket. OEM was subdued, which is going to come back strongly in second half. Our specialty division, which makes agriculture tires, OTR, and significantly export oriented, is going to show a robust growth again in second half. So we are still standing by our projections of ending this financial year with a double-digit growth.
Use PV sales as an early indicator, which is passenger vehicle sales. They're growing at 3 to 4%. Could that impact your business with a lag, but could that impact your business?
There is a lag of about 2 years from OEM growth rates to replacement growth rates. There's a very OEMs are growing on a very large base of last year. Hence, you are seeing a moderation of growth. We also have a market share game, right? So we have not yet got updated with the Q2 market shares, but we expect to continuously enhance our market share in a creeping fashion. In quarter over quarter, it is no major changes that we anticipate, but we keep going up. So we are looking at high single digit to double digit growth in passenger vehicle segment. In Q2, the growth was double digit in passenger segment. So we would like to see that going on in future as well.
Can I say that, and again, I'm just going to take that point forward because, first time I've spoken with you on this. You were saying that the real demand, which is the retail demand, and the auto industry growth, they are not parallel to each other. So by the time if there is a slowdown which comes to the tire sector, even if there is a slowdown in the passenger car or the auto sector, the lag effect could be 12 to 18 months minimum.
There are you're right. There is a lag effect direct. There is another factor at play in aftermarket. In addition to new vehicles entering the market, the driving habits are changing. People are not just commuting, huge highways and infrastructure investments are going on. So people are traveling larger distances more frequently, which means better usage of tires, which means faster replacement of tires. So replacement cycle of tires is also going to come down. So replacement market is going to be growing at strong single digit at least. That's what we feel. So we are bullish on replacement market, and we have to follow the trend on OEM with a lag, as you mentioned.
Share with you that I got my hands dirty. I had gone to actually replace tires for my car, and I was having a chat with one of the auto dealers, and he said, look, tire demand is strong. And I said, why? He said, because the cars have become heavier. It's no longer a small car, it's SUVs. And roads, and like you said, self-commuting is now really the way forward, which means that the consumption of tire plus the weight of the vehicle are two things which are having an impact on the tire demand per se. The fact that India is moving towards SUV and luxury cars, what does that mean for CEAT?
Well, it means a lot. 50% of the new vehicles are SUVs, right? And the luxury car at the top end is also growing much faster. So first of all, our new product development is tuned to that reality, and we have almost 90 to 95% of the tire requirements of those vehicles completely done and on offer through the dealers to the customers. Secondly, I disagree with the point of view that the tire life is coming down. With heavier vehicles, the tire life need not come down. And in fact, we are working hard to make sure the tire life keeps going up. But the driving habits are changing. If I was driving 10,000 kilometers per month, per annum, I'm now driving maybe 15,000, 16,000 kilometers per annum. So I'm driving much more. In the SUVs, you drive much more, both on-road and off-road. So off-road, that entire segment of off-road is also coming up, and CEAT cross-drive tire is positioned there and doing very well, and we are continuously enhancing that range. So lots in terms of new product development, in terms of technology and the brand. If you see our Crafted for the Curious campaign, the curiosity stems from exploring the unknown, which is about traveling on the highways and longer distances. So the brand is also shifting from a commuter landscape to an explorer landscape.
Okay, how is the market share for CEAT moving in the replacement market as well as in the new tire market?
Yeah, so new tire is OEM market where we are looking at the critical vehicles, the EVs, which is an emerging trend. We have a good position there. We have a 25% share there. It keeps fluctuating as we enter new vehicles. Then on the bigger SUVs also, we are focused on increasing our OEM share, which is going to come up over next 6 to 8 quarters. in OEMs. In replacement, we are a very close number 2, number 3, in the sense that not much difference between number 2 and number 3. There's some distance to be covered vis-a-vis number 1. And we expect to be market leaders in replacement in passenger vehicle segment by another 2 to 3 years. We are already market leaders in two-wheeler segment, which is motorcycle and scooter tires, and there's a big gap between us and the number 2. We are small players in truck bus radial, but we have seen some market share increase, but we are still single-digit market share in truck bus radial in replacement.
Okay. My other question is that I've tracked the tire industry for almost 2 decades now, and there are brands, big brands, but the margins in tire industry are never above 15%. It's a business where you sell a brand, but you get margins of a commodity. Why is that?
There has been historical reasons behind that. Lukewarm growth, extremely competitive marketplace, inability to take prices up. All that is changing. It's not changed completely, but price independence, I am talking of all players in the industry, has improved over the past 5 to 10 years as we speak now, and can improve further. As the country develops, as people travel more, the consumer segment of the business, which is passenger car and two-wheelers, are going to increase in saliency over the overall tire market. The commercial segment is more price sensitive and performance sensitive. It is difficult to take up prices completely oblivious of competition, but that independence is far higher on passenger segment, on the passenger car and two-wheeler segment. So market structure is changing, the behavior, the competitive structure is changing, and I think going forward, our intention is definitely to as soon as the raw material prices stabilize, that's a cyclical thing, but long-term margin should go up from here on.
So just to wrap it up with one final question, the India's GDP is growing at 8%, nominal GDP is 12%. Can I say that is the guaranteed growth for tire industry for next 2-3 years, 12 to 14%?
I would, I cannot hazard a guess there, but if you look at the current rate, the commercial vehicle growth mirrors the GDP of 7 to 8% quite closely. And the two-wheeler depends on the rural economy quite a lot. So which part of the economy is growing at what rate, it matters much for the two-wheeler and also to some extent the passenger car, the smaller car segments. So we have to look at which part of the economy is growing at good rate. But overall, I agree with you. I'm quite bullish about the domestic growth in tire industry.
It's so great having you on the show and, chatting pretty candidly about not just the earnings, but of course the industry as well.
Thank you very much.
There comes a time when your heart calls for you to arise. Plant your feet solid into the ground. Decide your own limits. And then break right through them. Become something more. It's my time to rise.